One of the most important skills you will need to master in Chapter 1 is analyzing transactions and determining the accounts affected by each transaction. In this video, we will review Problem 1-1A from your textbook. The problem can be found on page 44. In this problem, Cheryl Rogers opened a tutoring service, and she had the following transactions for January. In the first transaction, Cheryl invested $8,000 cash in the firm. Keep in mind that every time a transaction occurs, at least two accounts are affected. The first account is cash. The business had no cash until Cheryl invested the $8,000. So now the business has $8,000. Under capital, Cheryl Rogers' capital is going to go up by $8,000 because just by definition, when the owner places their own personal assets in the business, it goes under owner's capital. That is the owner's investment in the business. In B, Cheryl purchased office supplies on credit for $19.50. Okay, so remember we have to pick out the two accounts affected. So now, since she's purchased office supplies, she's got $1,950 more office supplies than she had before. When you purchase something, you either pay cash or you'll pay for it later. And in this case, the problem says that she purchased them on credit. So that is under accounts payable. Remember, the definition of accounts payable is something that is owed by the business. In C, Cheryl purchased office equipment on credit for $7,000. That's a very similar transaction. She now has office equipment that is going up by $7,000, and she also purchased this office equipment on credit. So her accounts payable, or what she owes, is going up by $7,000 as well. On D, she invested a personal computer valued at $2,500 into the firm. So instead of putting cash in, this time she took her own personal computer and placed it in the business. So that is an investment. Even though it's not cash, she invested her personal computer. So the office equipment will increase by $2,500, and since it's the owner's investment, the capital account goes up by $2,500 as well. In transaction E, she paid rent of $500. When you pay rent, of course, you have to pay with cash, and that is going to decrease the cash by $500. And we paid that cash for rent. So rent is an expense, so it comes over underneath the owner's equity under the expense account. Okay, we don't have to put a minus there because it's already there for us. Expenses always decrease owner's equity. In transaction F, we received cash for tutoring fees. Okay, so Cheryl has done some work. She's earned tutoring fees of $700. It says that she received cash. So our cash will increase by $700. And if we're going to say what this cash is for a revenue that she's earned. So anytime you do work and earn a revenue, it's coming under the revenue account. On transaction G, she paid salary of receptionist $400. Okay, so if you've paid out a salary, then you pay that in cash, so your cash is decreased by $400. Salaries are an expense, so that comes over underneath the expense account. In H, she paid $1,000 of the liability for office equipment. So remember earlier she purchased office equipment for $7,000 on account, but now it's time to pay the bill. So she paid a part of the bill. She paid $1,000. So we've got to decrease cash, and then we're going to decrease our liability. So when you pay one of your bills, you decrease the amount that you owe. And so that's what Cheryl did. She decreased her accounts payable when she paid the bill. In transaction I, she received cash for tutoring services. So if she received cash, cash is increased, and she has earned a revenue of $1,200. In transaction J, she paid the utility bill of $390. So when you pay a bill, cash goes down, and utilities are an expense, so the other $390 goes underneath the expense account. Last transaction, Cheryl withdrew $900 cash for personal use. Okay, so she took $900 out of the business, and that is something that we call drawing. When the owner takes assets out of the business for their personal use, it's referred to as drawing. So that is going to go, we don't have a separate drawing account, so we're going to put it under the capital account, but it reduces capital by $900. Okay, so the final thing we want to do is add up all our transactions for each account. So I'm going to add up the cash. I'm adding 8,000, subtracting 500, adding 700, subtracting 400, subtracting 1,000, adding 1,200, subtracting 390, and subtracting 900. So the final balance in the cash account is $67.10. Okay, office supplies is easy to add up. It's just $19.50. Office equipment is $9,500. Accounts payable, it increased by $19.50, then increased by $7,000, and then decreased by $1,000. So accounts payable is $79.50. Cheryl Rogers' capital, she increased it by $8,000 with the cash investment, then increased it again with the equipment, and then decreased it with drawing out the $900. So $9,600 is the balance in her capital account. Under the revenue, she earned $1,200 and $700, so she has earned $1,900 total, and the expenses add up to $1,290. Okay, so now we have to make sure that our accounting equation is in balance. So the first thing we'll do is add up all our assets and place it in this cell. So 6710, 1950, and 9500 equal 18,160. Okay, now we'll add up our liabilities and owner's equity side. You have $79.50 in accounts payable. It says to add the capital of $9,600 and add the revenue of $1,900, and then we're going to subtract our expenses because remember, expenses decrease owner's equity. Okay, and so when I subtract the $1,290 for the expenses, my total liabilities and owner's equity are $18,160, just like the asset side. Keep in mind, assets must equal liabilities plus owner's equity. If not, you have an error and you have to go back and find your error.